Hi, this is Nancy with Lock Rate Mortgage, and this is your Fast Mortgage Insight. Today we're going to talk about the difference in income for mortgage financing purpose. But before we do, just a little history on income requirements for mortgage financing so you have a better idea and understanding on why these requirements exist. So back in the days, lenders would lend hundreds and thousands of dollars to anyone who pretty much had a heartbeat. They didn't ask for much documentations. They would allow you to state your income by having your employer just simply write a letter, or they would even use bank statements to show that you have funds available enough to make your payments. And for that reason, banks were offering loans to everyone, including high-risk loans that many homeowners ended up defaulting on because they couldn't afford it. And of course, that led to the market crash in 2008. Since then, lawmakers have enforced specific credit and income requirements along with document guidelines for each different program to prevent that from happening again. Now let's talk about some of the different incomes and general requirements based on today's guidelines at least. Now the key here is that lenders are looking for 2 years of stable income, meaning that you've been and will likely continue to bring in that source of income. If you are a W-2 employee, lenders want to see that you have 2 years of continuous employment in the same line of work. That can be, of course, in the same company, or if you change company, as long as it's in the same line of work, they will allow you to count that. However, if you change industries or line of work, that does restart the clock. The exception of the continuous employment history gaps would be if, say, you took a break due to a medical leave or a family leave, and you go back to working for the same company, or if you go back to working into a different company, as long as it's in the same line of work, they will allow you to continue counting that as income. Also, if you're technically employed but on a leave of absence due to medical disabilities, they will require a letter from your employer and a letter from the doctor that matches, showing your anticipated date of return to work. On a side note, your employer will also be asked to verify that you will be returning to the same position and pay for the lender to use that income. If you've been a full-time student with no prior employment history, as long as you begin working for a job in the same subject of your studies, they will allow you to use that as your new income. If you are retired and on Social Security or receiving a pension, they will ask to see proof of receipt, and that can be anything from your 1099 tax forms, your actual tax filing, bank statements showing your current receipts of the deposits, or your Social Security award letter. If you are drawing from an IRA, annuity, or retirement account, they will ask to see proof of receipts. That can be from a 1099-R form, tax filing, bank statements showing current receipt, or a letter from the financial institution confirming the amount of your draw and the frequency. Additionally, the lender will ask for a bank statement to confirm that you have enough to cover a 3 years continuance, regardless whether you plan to actually draw for the full 3 years, but they want to make sure that the balance is available. Now, if you're having trouble qualifying for a conventional or government loan due to the lender's income requirements and their programs, just keep in mind, don't get discouraged. There are other programs available that do not conform with Fannie and Freddie's guidelines. They're called non-QM, and that stands for non-qualified mortgage. You may still qualify for additional financing. I'll save that for a different video and explain those programs and qualifications. Don't forget to like, subscribe, and hit that bell so that you can get notifications for the future videos. Trust income is allowed as long as you have been receiving that income for 2 years, and they will ask for bank statements, again, to show that you have enough in reserves for a 3 years continuance. Okay, for some fun income, rental income. This one gets a little bit tricky, so let me break down scenarios for you. What if I rent out rooms in my home? Can I use that income to qualify? That's actually one of the most common questions I get. Most lenders don't have programs that allow you to use boarder income to qualify. That is when you rent out rooms in the house in which you reside in. On the other hand, they do allow you to rent out individual rooms in a property in which you rent out completely. Rental income you can use are from houses or businesses in which you do not live in yourself and are reporting that as income on your taxes. You can use new rental income that was not previously reported on your taxes, or if you can prove that the property has previously been vacant due to some major constructions or renovation, and now you have a new tenant moving in, they will allow you to use those income with a new rental agreement to verify that income. However, you can't go and just increase your current tenant's rent or substitute it with a new tenant at a higher amount and provide that new contract and say, hey, my rent income has now increased. They will not allow that. As to documentation, you can submit at least 2 years of tax return to verify your rental income. They calculate your net rents after deductions on your Schedule E, which in many cases landlords do write off a lot to avoid paying more taxes, but it's a catch-22. So if you're trying to show a high number of rental income, that doesn't really help. Your other option, instead of using taxes, is that you can use your rental agreements accompanied by your bank statements showing current receipts. Keep in mind, rental income must be verifiable. That can be from canceled checks, money orders, bank transfers from your tenant. It just can't be cash that your tenant handed you and then you go down to the bank and deposit into your bank account. That's not verifiable. For such rental income, they will calculate your income based on 75% of your rents received, less any PITI. PITI, what is that? It's your mortgage principal and interest payments, plus your property taxes, plus homeowner's insurance due for that property. On a side note, when you're using such income, they will also want to make sure that you have at least 3 months of PITI in reserves in case of an emergency. Another tricky scenario is self-employment. That is when you own 25% or more in shares of the business or are working 1099. In such cases, to consider your income as stable, lenders want to see that your income is consistent or at least increasing annually. If your income declines more than 25% from the previous year, they will not consider that as stable income. Keep in mind, your business may generate a lot of income. However, the underwriter will go off your net income reported on your taxes or your K-1 schedules plus your W-2 wages from the business. They do allow you to add back certain expenses like depletion, depreciation, meals, entertainment, expenses from your use of the home to calculate your final annual income. Now, if you're self-employed and own less than 25% of shares in the company, they treat your income similar to a W-2 employee based on your pay compensation. Again, keep in mind these are very general, conventional, and government loan requirements based on today, but each lender may require something different. And that was your Fast Mortgage Insight. Please don't forget to like, subscribe, and ring that bell so you can get future notifications. Bye!